And welcome back to the Financially Simple Podcast. Just adjusting my earphones there. They were bothering me right as the start. Hey, for those of you wondering what I'm talking about, yeah, we're recording the video format of this and uploading it to YouTube. You say, Justin, I didn't realize you had a YouTube channel. Yeah, we do. It rocks. I think there's just over 100 hours of content on there that can help you. We have short videos, we have long videos like this one today. So today we're still in the cash flow section of our little series for personal finances for us business owners. I want to deal with a topic today that may be applicable to some of us. And that's the question is, and it was actually came from a client. They said, Justin, I have an old pension. What should I do with it? I have an old pension. What should I do with it? So maybe you find yourself having a pension. And you're now a business owner and you don't know what to do with a pension. This particular individual, they said, Justin, let's just cash it out. No, stop. No. We're not going to do that. Not going to happen. Let's deal with some basic questions to bring everybody up to speed then. First question is, what is a pension? You're like, Justin, I've never even heard of a pension. Well, in the old days, you didn't have a 401k at work. And what you do is you would work for the company or the man for years and years and years, and then you would retire, and then the company would pay you a monthly payment, similar in size to what that salary that you're receiving all those years of working for them. A lot of companies don't do that anymore, and the reason for it is because the pension plans are expensive. You have to have a lot of money in order to provide income, and people are living longer. In the old days, you didn't live to be 90. Now, one of the largest areas of growth is in the centennials. People living over 100. As a percentage, it's unbelievable the amount of increase because of exponential technologies. And we're just living longer. And so pensions are pretty expensive now. And as such, many years ago, companies started using 401ks, 403bs, these different type of retirement accounts, and pushing the retirement responsibility off on to the participants of their company. But maybe, just maybe, you happen to work for maybe a government organization. Yeah, the government doesn't have any cost controls on it. Maybe you work for a municipality or the state or the federal government. Maybe you work for a large corporation. There are many large corporations who still offer pensions. I run into this not so often, but probably 2 or 3 times a year, where an individual working for, let's say, a Fortune 500 company has been there for 30 years, and now they have a pension. And they've been in business now for a couple of years. What do you do with this? So let's deal with some basic things first. Whenever you retire, whenever you reach fully eligible age, you're going to have the ability to choose a payout. So if you have a pension, you're going to go to the pension company, whoever that may be, even though you've not worked there for years. You're going to go there and they're going to say, okay, Mr. What do they call it? Participant is what they call you in a pension. Mr. Participant, you have, I'm going to keep it simple today. You have 3 basic options that you can choose. You can choose to take equal payments over the rest of your life. And whenever you die, there are no more payments. That's called a single life option. So maybe you're single. You don't have a spouse or you don't plan on getting married. You may take the single life option. And whenever you pass away, there's no more money to be heard. What happens though if you're married? My dad had a pension. He worked for the state of Georgia. And whenever he passed away, my mom was the beneficiary of that pension. And so he elected what's called a joint and survivor option. So it was a joint contract. So it was covered both their lives. Should dad had lived into retirement, then he and mom would received a smaller amount. They wouldn't have got as much as dad would have as life only. But nonetheless, they would have received an income. And then if dad predeceased mom, then mom would continue the same income for the rest of her life. That's called a joint and survivor payout. And so the monthly checks you receive are just a little bit lower than that of a single life. But nonetheless, if you live to be 170 years old, they're going to still theoretically pay you underneath a joint and survivor option. Another option you can do is what's called a period certain. Period certain. You're basically going to take a specific period of time and say, I got this much money. I want you to pay me that over this set period of time. And after that time period, you pass away, your beneficiary is going to continue to receive money up into that time period. So you may say, I'm going to get a period certain with a joint annuity. So you say husband and wife, they're together, they're going to live, but I want that period certain to last 10 years past the past the primary participant's life. So the way this would work is dad and mom would receive income. It'd be a little higher because it's not guaranteed for the rest of mom's life. Dad passed away at age 60, let's say, and let's say it was a 10-year period certain. My mom would receive income for the next 10 years. And after that, no more money. It doesn't matter if mom lived to be 120 years old. After 10 years in a period certain, there are no more money. There is no more money. At least speak correctly. You would think I'm from the South. All right. So in a pension plan, we receive basically a set payment for the rest of your life or you and your spouse's life. That's the basic concept. However, because of the low interest rates for the last few years, many pension companies are now reaching out to the participants and saying, hey, look, we'll let you have a early lump sum payout. They call it lump sum. Think about a lump of butter, a lump sum payout. Well, now here's how this works. Let's say that let's say you reached age 65 or 66 or 67, depending on your particular pension plan, and you want to retire, but you don't want guaranteed income for the rest of your life based because of the pension. Instead, you just want to get your money. So what they'll do is the pension company will calculate what would have been paid to you over your lifetime. They'll take an assumed interest rate, and then they'll calculate what the lump sum payment would have been increment over your life, and they'll give you a lump sum amount. In recent years, pension companies have been reaching out to people in their 40s and their 50s and saying, hey, look, we know you have a pension that you're going to draw on in 20 years. We'll go ahead and give you X number of dollars for your pension. Do you want to take it now? And so that's a question that we're going to come back to in a little while. So let's first deal with some pros and cons on the level payment versus the lump sum. So let's deal with the level payment. We're going to call it the fixed annuity payment because that's basically what it is. Okay. Basically, the pro is you're going to get income on a regular basis, scheduled for the rest of your life. No matter what happens out there, as long as the pension is viable, which is a whole other issue, but as long as the pension is viable, you're going to continue to get your stream of income for the rest of your life. The cool thing, another pro is you're not responsible. You're not taking on the burden to make investment decisions. The pension company is hiring professionals like me to go in and make decisions for that pension plan. And you also you're protected. There is some protection with the fixed guaranteed portion on the sale of the employer, on the termination of plan. There's some protection whenever you're taking regular payment. The reason why I'm kind of stammering there is because I didn't know how to say it. You have what's called the GBPC, the guaranteed benefit. My mind just went blank, guys. The Benefit Corporation, the GBIC, Guaranteed Benefit Income Protection. PBGC, Pension Benefit Guaranteed Corporation. If I could think today. Sorry about that. The Pension Benefit Guaranty Corporation, the PBGC, provides protection against the termination of a pension plan or the sale of your employer. Let's say a company merges, they sell the company out. The PBGC, the Pension Benefit Guaranty Corporation, which I have it in my notes if I could read here, the Pension Benefit Guaranty Corporation protects you. Now, whenever you have the fixed annuity amount, that is a sweet little deal. Guaranteed payments for the rest of your life. You don't have to worry about investment decisions, and you got some protection that's an insurance type policy. Pretty cool. The con is this. Is your income is maybe static. A lot of pensions did not include a cost of living adjustment. We call it a COLA, C-O-L-A, a cost of living adjustment. A lot of pensions didn't have a COLA on them. And so therefore, if you're receiving $1,000, $2,000 a month at age 65, and all of a sudden at 95, you're still receiving $100 or $2,000 or $2,000 a month, man, it doesn't have the same buying power. In fact, it may feel like $200. So the danger with the pension is you're vulnerable against the inflationary effect. Another danger is if the health of the if the health of the primary benefit, the participant on the pension is poor, and you choose the wrong option, you can end up harming the beneficiaries or the dependents. So let's say my mom and dad, my dad whose health was not very good, let's say he would have chosen a life-only payout amount. It's an irrevocable decision that you have to make whenever you retire. And mom would have been left with no income off the pension for the rest of your life. So that's a con when it comes to the fixed annuity payments. So let's flip over to the lump sum withdrawal. The cool thing about a lump sum withdrawal, the pro is that it puts the money in your hands for you to make the investment decisions. I personally like that. It's not only because I manage money, but it's because I can see that many times these pension companies, they're not trying to get a return that matches your particular lifestyle or your particular needs. Whereas if you get control of it, you potentially can make the return of the portfolio match the return that you need for your lifestyle. So you can control the assets. The cool thing is that whenever you take a lump sum, you're going to continue the tax deferral because you're going to switch the money from the pension company into your IRA. Because you can control the investments, you have the greater ability to potentially outpace inflation. Because you can invest it, instead of trying to make 3, 4, 5%, you could try to make 8, 9, 10%. And once you get the money, if something happens at the pension company, let's say they're underfunded for whatever reason, forget it. You've got your money. You're protected. Now, the con to a lump sum withdrawal is this. You are responsible for providing yourself your income for the rest of your life. That is a con. Remember I said you have the opportunity to make investments. If you make poor investment decisions and you took a lump sum out, there's no one else to blame. You're not getting any more money from the pension company. It's up to you at this point. So that's the con. Another one is that if you take a cash out and you do not roll them over into the IRA, you don't do a rollover is what it's called. You don't do a rollover, you're immediately liable for paying taxes on that distribution. So that's a major one. Another one is you are in danger of spending your assets too fast. So many people, they don't realize the way the spending should work out of retirement accounts. And all of a sudden they see they have a huge lump sum of money that comes from a pension, and they want to go out and buy themselves a new bass boat, a new four-wheeler, a new hunting dog, a new house. All of a sudden they don't have enough money to pay for their life pay for their assets the rest of their life. Another thing is like I mentioned earlier, you could hurt yourself because of losses. You don't invest right, and you could hurt yourself 20 years from now. So those are the pros and cons for dealing with pensions. So what do we do? I've been giving you a lot of back study to come to where I'm at in the conversation. Justin, I got a pension. What do I do? So let's do some do's and some don'ts. The first thing you are going to do is you are going to wait until you reach full retirement age before you turn this faucet on. Before you turn the faucet on. So you are going to wait. That means don't take income from a pension while you're still earning trade or business income. Do not withdraw the funds early. Okay, just don't do it. Number two, what you are going to do is you're going to talk to your planner about running a net present value calculation if you are offered a buyout. So if you're offered a buyout, you're going to talk to your planner to see if it makes sense. I've calculated probably a dozen of these in the last year. Man, I've seen some pensions that have a crediting rate based on the calculations. They're making 8.5%, 9%. I'd be a fool. That'd almost be malpractice for me to go in and tell somebody to cash that out or to take a lump sum distribution. Now, I've also seen some that are only crediting 1.5%. Just not the numbers just aren't there. In that case, they may want to take a lump sum distribution. So if you get offered the ability to take money out of your pension, talk to your planner, have them run a net present value calculation. But if you do decide to take an early buyout, do not cash it in. Do not cash it in. You're going to do a rollover instead. You're going to roll it over to your IRA. If you cash it in, you could potentially face a ton of taxes. A ton of taxes. So what are we going to do if we get an early buyout? We are going to talk to our planner and we are going to run a net present value calculation. But if you take the money out, we do not do a cash out. We do a rollover. and move the money to an IRA. You are going to delay any income whatsoever as long as you are making income. Earlier I said you are going to wait until you reach fully retirement age. That's idealistic, but sometimes I have clients who've made enough money and they can retire in their 40s and 50s. In fact, I've got another one retiring at 43 years old. I don't know what they're going to do, but they're going to retire and travel the world. They've been working hard for the last 10 years. We helped them reach that goal. So if that's you, you may want to take out money out of the pension before you reach full retirement age. But if you do, you are not allowed to take money out of your pension if you're working with yours truly while you're making trade or business income. It's just going to create a lot of taxes. You're going to pay taxes on money you really don't need to, and you can allow it to accumulate longer for you. Why am I covering this now? The reason why is that because we have many business owners who are second career business owners. They've worked for the government, they've worked for a school, they've worked for a municipality, a big corporation for years. In fact, I've got a consultant that I'm interviewing right now to come in and work with our company, and he worked with a major corporation, has a nice pension plan. And if you're looking at that pension plan to try to create cash flow for you right now, more than likely that's not the best place to pull money from, more than likely, because once you start that draw, it is irrevocable in nature, irrevocable. So if you have a pension, speak to a qualified financial planner who understands how that incorporates. If you have a pension and you own a business, your rules are different. You're not working in the same sandbox. You're not playing in the same sandbox as those who are non-business owners. So it behooves you to speak to a financial planner, run the calculations, and see if you need to take, when you need to take income from the pension. So I hope that kind of gives you some insight. Look, on this particular episode, we're going to have a do and don't list, and we're going to have some graphics on the blog Financially Simple. And while you're on the blog Financially Simple, do me a favor, sign up for the newsletter. We have thousands of people who receive our weekly newsletter. In fact, we've been talking about the new book, it is coming. We're about ready to do an unboxing on this thing. I can't wait for you to see this. The book is awesome. It's not just because I wrote it. I've actually had some professors read it and like, Justin, this is really good. I'm like, thank you. So the book's coming out. So while you're on the blog, sign up for the newsletter. It's Financially Simple. It's right there on the main home screen. Do me one other favor. If you like the podcast, if you like the new format, me talking about personal finance, do me a favor and go into whatever your station that your provider is, whether it be iTunes, Stitcher, Spotify, iHeartRadio. I mean, we're just about on 17, 18 different providers right now when you're listening to this episode. Go ahead and do me a favor and leave me a review. Leave me a review. If you're on iTunes, give me 5 stars if you think it's worth it. If you give me 1 star if you don't, say, hey, Justin's full of crap. He didn't know what he's talking about. If you like the episode and this is helping you, do me a favor. Go in there and leave me a review. This is how we drive traffic to the podcast. It's also how we drive traffic to the blog. I'm excited about what we're covering now in personal finance. So we're going to come back to pensions when we get over into investments in a little while, but I wanted to cover this today specifically for cash flow on those do's and don'ts. Look, I say it every week. Life is hard, life is good, and life can be frustrating. Pensions, they're pretty easy. They're relatively straightforward. There's some maximization strategies you can do. We'll talk about that later. Look, money doesn't have to be any frustrating. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.